Okay, hello everybody. If you can just do me a favor and put a Y in the questions or the chat box if you can hear me okay. Okay, we can hear me fine. Okay, so today I wanted to try and stimulate a bit of thought on how order flow information can be applied. Now, when people first come across the term order flow, it's often because they've seen a video about it or heard an educator's perspective on it. And that obviously has an influence on how that person perceives order flow information, what it is and how it can be applied. And it's common that people see order flow as a technique or a method. So they hear one perspective on order flow, think that that is the method, and don't consider other ways to integrate order flow into their trading. And order flow is really not a technique. It's just a set of information, just like price charts show a set of information about price. Order flow tools just show information about order flow. And just like price charts, order flow information can be used in different ways, and not all of those ways will be immediately obvious. And I can say that with some authority because they certainly weren't obvious to me. And so we're going to focus today just as much on the whys of order flow as much as the how or the what to look for. So we'll look at the different states of the market. We'll consider what we'd see in each of those states, and that's probably something different to what you're thinking of right now. And then we'll finish off by looking at the learning curve, because there's some elements of order flow that are much easier to use than others, and it makes sense for any new traders to focus on those elements first so they actually benefit earlier on. Now, what we're going to discuss today, we are going to talk about techniques you can use to enhance your trading, but how you implement those techniques is going to be unique to each and every one of you. Now, just last week, I had a call with a Jigsaw customer. He may actually be in this room. And he told me he wanted to become a scalper. Now, we talked about what he was actually doing now with his trading and what his options were in terms of getting trained as a scalper. And then I asked him, are you okay throwing away most of what you know about trading and started again? Because scalping was so different from what he currently did that his current experience wouldn't actually help much with what he was planning to do. Now, I can't make decisions for people, but when I pointed out that he was effectively starting over, he was horrified and told me he hadn't thought of it like that. Now, what he actually decided to do, I don't know. He hasn't told me. But really, he didn't realize what a big change he was actually thinking of making. Now, I'm not against people learning about other styles of trading. In fact, I've had a number of people teach me scalping techniques, but it's not something I do on a day-to-day basis. I just like to know as much as I can about trading, and I like to know how other traders make their decisions. I feel that knowledge kind of gives me a better overview of the markets as a whole. Now, when you learn new things like that, of course, they're going to have an impact on the way you trade, but it doesn't mean you have to stop what you're doing and trade like the last person that taught you something. Now, sometimes I get traders email me and say, okay, I see the order flow, I understand it, what do I do next? And my answer to that is usually, well, you haven't given me enough information to really give you an answer, or rather, without knowing what you were doing before you came across order flow, what you believe was working for you and what wasn't, it's very difficult to make any suggestions as to what you should do next. And I absolutely could do more harm than good answering the question with limited information. So what usually happens is I'll get a question with zero information, just saying, tell me what to do. Then I have to go back and kind of pull out of them exactly what it is they do now, and then make some suggestions to kind of nudge them in the right direction. Because to make improvements, you need to keep the good stuff and cast aside the bad. And part of doing that is to take an honest inventory of what is actually working for you and what isn't. So forget what you like and what you don't like, because the market doesn't care what you like to do at all. So if you implement new techniques, you're going to have to figure out how to do that and monitor the results to make sure it's really helping. And the process of changing your trading and tracking the results is just as important as the actual trade changes you're going to make. So if you don't have a way to assess the impact of the changes, it's very difficult to know, is it really working or not? So this webinar is not about resetting your trading or throwing away what you do now. To an extent, this webinar is about perspectives, or all about how you think about the markets. It's about understanding what makes the markets move. In fact, we're not going to discuss a single technique today without explaining why it works, what is going on in the market. And that why it happens or why it works is much more important than how do I trade it. The more you know about why things happen, the more you'll be able to think for yourself and figure out your own ways to trade it. Now, of course, that is something that many new traders resist. Many traders are very one-dimensional in their approach to trading. And the one-dimensional trader basically wants somebody to tell them how to trade. The one-dimensional trader wants a pattern to trade. The one-dimensional trader does not want to use discretion. And there is a belief that trading is simply about patterns, and that once you have the right pattern, you can just repeat trading off that pattern and make money. Now, once I had a discussion with a trader about this, he was looking for patterns, and I was telling him, you got audio, David, okay. This trader was looking for patterns, and I was telling him that maybe it would be better to understand how the market worked, what drives people to buy and sell, where the pain points might be for people, the process of running out of new buyers and sellers. And to that he replied, well, why don't you do that and then just tell me what pattern those things make and I'll trade the pattern. Which is fine until the pattern changes, or on a day where the pattern is a little bit different, where it's a little bit unclear. Now, it's not as if this person wasn't willing to put the time in. So this guy had been a losing retail trader for at least a decade at that point. He just believed that trading was about patterns. Now, that's despite the fact he'd been looking for more than 10 years for a pattern that worked. And after 10 years, he still thought that looking for a pattern was the right approach and that using discretion was too much hard work. In fact, he didn't just believe the market was about patterns, he wanted the market to be about patterns. He liked patterns. Patterns were lovely, easy to trade. The problem is the market didn't care what he liked, and he lost money for 10 years straight. Now, the problem with the pattern approach is you're really left with no solutions when the pattern fails. The market is nuanced, and even though you might not want it to be nuanced, it still will be. And with no depth of understanding of the markets, the one-dimensional trader can't find solutions to problems. All he can do is look for another pattern and keep looking for patterns until he finds the right one. Now, the two-dimensional trader is looking to enhance their pattern-based trading with order flow. So his patterns aren't working well, so maybe order flow is going to fix my patterns. So they come to order flow and they ask a simple question, and I get this all the time. Can you just tell me what to look for or where to get in the market? They might say, what's an entry signal on Auction Vista or Depth and Sales? Or can I just trade the circles on Auction Vista? In other words, they're still looking for a pattern. It's basically, don't bore me with the detail, they say. Just tell me where to get in and out of the market. Now, occasionally people get quite upset with me when I tell them that, look, that's just not how it works. That they need to understand cause and effect. And they don't want this because they want that shortcut. But is it a shortcut? In my experience, the people looking for simple patterns, instructions where to enter and exit, these people do not get anywhere. It's why you see people on trading forums that have been trading for 5, 10, 15 years and are still hopping from one thing to the next. It's just not a shortcut. It just feels like a shortcut, or it feels like it should be a shortcut. Now, I haven't had people say to me, when they look at some of the webinars or they look at, some of the posts we do, they say, oh, that's clever. I'd never have thought of that on my own. And this is where being a three-dimensional trader comes in. The three-dimensional trader makes decisions based on how the markets work, or their understanding of how the markets work. So for every trade, there's a why. Not all trades will work, and so every trade also has a why not, or an exit point that has a reason. And there's also the knowledge that regardless of what you do or how good you might be, things simply don't work out a lot of the time. You have to cut trades. Now, when I started trading, the first course I purchased, I've never told anyone this before, was a course called Trading the Easy Way. Certainly didn't tell my wife at the time that I was buying that course, the amount it cost me. And you can imagine how well that went. I put my time in as a one-dimensional trader, but I found out that if there's a shortcut in trading, then it is using discretion. Because the patterns aren't a shortcut. They're just a dead end or a series of consecutive dead ends. The shortcut is accepting that trading is discretionary, and it's a bit more like reading a story than looking for a fixed pattern. So we're looking for cause and effect, looking for causes that are likely, but not guaranteed, to have a specific effect on the market. So if buyers are trapped, they will need to sell to exit their positions. So you might see that buyers appear to be trapped and you sell into that, but then the buyers win out and you lose that trade. And that is absolutely fine. You knew why you were getting in. You thought it was probable that buyers were getting trapped. And after your entry, you could see that the buyers carried on hitting into the market. Price got past the point where you thought they were trapped. They won, you lost, you exit the trade. So everything we're going to talk about today is going to be based on being a three-dimensional trader, on considering all other people's trades, positions and stops. So let's just dive in and look at an example. Now the first example is the reason I believe you should always have your time and sales showing. When you're reading order flow, time and sales is really useful, but a lot of people are scared of it and a lot of people don't want to look at it. So in this case, I'm actually using the Jigsaw version of time and sales, the reconstructed tape. And what I've got here, I've got it filtered to show trades of 50 contracts or more. And we're looking at the S&P 500 futures. And it's also just showing trades from the last 3 minutes because I like to be able to just glance across and see just the recent history. Now also with just a part of the price showing and the volume showing, I can actually glance across at this and absorb the information pretty much instantly. It's nice and easy. It's enough information to make a decision, not too much where it takes a long time to read. So I can glance across at this, less than a second of eyeball time, and it's in my head. I've absorbed it. It's perfect for a lazy trader like me who likes to keep things simple. Now note also that my general rule of thumb for me is if it can't fit on one screen, you can't use it. Don't bother. So I do look at long-term charts before the open, and I do my prep based on that. But intraday, I only allow myself to look at one screen per market. So obviously, I'm looking at multiple windows, but I'm only allowed to have one screen. So if there's something else I want to look at, but I can't fit it on that screen, then I don't use it. I don't use it. Just trying to keep it simple. Anyway, what we're looking at specifically is a common cycle that occurs over and over again in the market. So it moves up, you will see a lot of buy market orders. Okay, the green ones are the buy market orders. Not all of them, but many of those are very short-term trades. Now some people will tell you to wait for these large trades and trade with them. Now I don't do that. I'm not saying it's wrong, it's just not part of what I do. You can't, as a trader, trade everything. So it is smart. So thanks, Guy, about the animation. It is smart. It's a smart thing to do to say, okay, I'm actually going to wait for the big guys to come in. And when the big guys come in, then I'm going to jump on the trade. It's smart and it's very logical. It's smart. I think it's not a bad thing to do. But when you've got your own strategy and you've got like 500 potential things you could look at, you simply can't take them all into account. So for me, I don't look at it. Doesn't mean it's bad. It just means it's too much for me. Okay. So basically, great. Follow the big traders. That's fine. Okay. But I think this scenario that we're seeing here is much more rewarding. So what happens is you see the large prints and then the market's going to move up. Then you see more large prints, more moves up. Then you get to a point where the size or the large traders are no longer getting any reward for their efforts. So you'll see the large prints and no move up. Maybe a few more large prints, still no move up. And that's what we're seeing here. We're seeing lots of buy market orders up to 37. And we can see when we hit 37, we hit 37, come down a couple of ticks. Hit 37 again, come down, hit 37 again. It just can't get through 37. Now we also see the large trade circle here at 37, and that the market is flatlining. But really what we're looking at here is this. It's not just enough to see the large circle. This here, this fact that we keep hitting 37 with size is telling you something. It's telling you something very specific. It's telling you something that the circle doesn't tell you. The circle does tell you there's a lot of size here. The circle does tell you that, you know, it's mostly blue, it's mostly buyers, which is kind of an imbalance. That's all well and good. But it is always nice to see big sellers getting trapped. It's kind of it's icing on top of the icing on your cake. Now, one of the interesting things about this is that it's like we call it a pregnant pause in England. There's a pause as it sinks into these late longs that they're caught offside. And so there's that kind of pause as that realization sinks in, just as you would yourself kind of pause if you were stuck in this situation. So think about when you go long and you're watching the market not move up, you're kind of sitting in there in your chair and you're kind of willing the market to go, come on. I mean, my wife will come into my office and say, Pete, who are you talking to? And I'm like, well, nobody, the market, but just, I'm like, come on. You're sitting there, we all feel the same. We all want it to go, right? And you give it time, but eventually you're like, no, if I stay in this, it's going to move against me. And that's effectively what you're seeing here. You're willing the market to go up, then it ticks down. Then maybe it goes back to your entry point again. You're thinking, come on, okay, this time, go this time. But at some point you're going to give up. Because you'd have seen, unless you don't learn from your mistakes, right? If you don't learn from your mistakes, you're going to hang on to it every time. But most of us will have seen enough failed attempts to move up that you will say, okay, if I leave this any longer, I'm going to get out. Now, on the S&P 500, many people call that the second chance market. And they call it a second chance market for a reason. And the reason is it always gives you a second chance to get out. Or not always, but like it seems to kind of, when you're in a losing trade, it seems to keep coming back and saying, okay, you're going to want to get out. And then it moves away, moves against you and comes back and say, you want to get out again? It's a second chance market. And you can't, and you have to kind of, at some point, you have to take one of those chances. Now, of course, some of you, like I say, will stay in the trade regardless, hoping that the trade will work out. But obviously, that's not something you're going to be able to do forever. So anyway, on to the next slide. And we can see that inevitably, we take a drop down. We get a rush of large sell market orders, and the market pushes down. Okay, so we can see all these sell market orders that came into the market. Now, let's just be clear about one thing. Order flow analysis is not about knowing what everybody is doing. Okay, if you think that's what order flow analysis is about, you're very much mistaken, and you don't actually need to. So when we saw the large buyers no longer getting any moves their way, we can presume a few things about those large buyers. First thing we can presume is some of those large buyers could have been longer term traders, and those guys that don't react to short-term market action at all. Some of those buyers could be arbitrage spread traders, only caring about the spread between instruments in their trade and not the move in that one instrument at all. And some of those buyers will be short-term traders, maybe algorithmic or maybe human. And the fact is, it's the short-term traders that will cause the short-term reactions. And we really don't have to care about the mix of long-term, short-term spread traders. It's just not something we'll ever know, and it's not something we should really worry about too much. After all, if a trader isn't going to react in the short term, we don't have to worry about them. We can just presume that there's enough short-term traders in any area of high activity to cause a short-term move. Okay, so a lot of traders come into the markets really wanting to know everything, and you have to let that go, and you have to say, okay, I don't know what everybody is doing, but I know enough of them are going to react short term. Okay, that's all you need to know. And of course, you're going to be wrong sometimes, but it's enough to know that some of them are going to have that short term reaction. Now, there's a couple of other considerations when looking at this type of activity. First of all, if you take an hour or two to watch this, you're going to see that it happens quite a lot. And it usually gives us a little bounce. And often that's all we're going to get. So you do have to be selective. So in this example, it didn't happen at a significant area, but by the time it was over, we did have a step in the volume profile created at 37. But that's because we had all that size hit into 37 and not into 37.25. I think we got one large print into 37.25. But so at the time it happened, there really wasn't a reason to go short. And indeed, afterwards, the market just rallied up again afterwards. So you do have to be selective. In fact, you're much better off watching other aspects of order flow and just zooming in on this when you reach a key level. Just look across and say, a couple of seconds, yeah, looks like sellers are getting trapped or buyers are getting trapped. Now, second of all, and very important, is your risk, right? We saw that apart from one large trade, the market failed on multiple attempts to trade through 37, to trade past 37. So if you shorted this, you would not need a stop up here at 40, more like 38 or 37.75. But obviously, you would need to take into account overall volatility for that instrument on that day. So if it was crude oil, you're not going to try and do that. You're not going to try and fade that move with 3 ticks. On the S&P 500, you could scalp that with a 3-tick stop. Okay, so if you enter on large size getting trapped, you won't need a big stop, but it has to be said, you have to get a good price, right? So you couldn't, if you're looking to short because you got buyers trapped at 37, you don't want to be short in 36. You really want to be trying to get 36.75. So you want to see it keep going up to 37 and try and get a limit order in to sell 36.75. So in the next attempt at 37, you stepped into a trade. No point offering 37, right? Because you're just not going to get filled there, or very unlikely you're going to get filled there. So you won't need a big stop, but you do have to get a decent entry price. And of course, this skews the risk-reward ratio in your favor. And like many order flow entry signals, it helps you get a better price. It helps you know where the better price is. It's going to keep going back to 37 and trading it. So you're a tick away from your level. Now also, the thing also about this initial pop, these entries where you're getting in, where you're likely to have a pop, right? The pop does not guarantee you continuation, but what it does do, it gives you breathing room in the trade, right? Because when you get that 3 or 4 tick pop on the S&P or the 8 or 9 tick pop on crude, all of a sudden you're on side in your trade, and even if it comes back at you and with a lot of order flow and it's coming back at you, you've still got time to manage the trade. So these entries where the market's going to pop are really cool if you can nail those entries, because they give you a bit more time. So you've got more time to make a decision, and a trade that usually doesn't just move instantly against you. Now, from a 3-dimensional trader perspective, what exactly did we do here? First, we weren't looking for a pattern. Second, we were looking for short-term, long traders to get caught offside in a move up. They did get caught offside, and the market popped down in the short term when they got stopped out. Now, we know that we can't identify every trader as short term, but we know enough short term traders will react to cause a short term move. Now, we could explain what was going on, what the likely outcome was, and importantly, we could identify at what point the market was not doing what we expected. After all, this is not always going to result in a prop. Sometimes you're going to get in, market's going to run you over. It happens to everybody. So we had the confidence in both our entry and our stop location, and really the profit side, it's not really a consideration. The profit side, that's pretty much going to take care of itself. Now, there is a heavy emphasis in order flow tools and education on areas of high participation, both medium term and short term. Okay, so if you look at the FT71 webinars, he talks about long term volume profiles, high volume areas and low volume areas, and you look at people that are teaching people to use footprint charts. Again, there's a lot of focus on, these areas on the footprint charts where there's a lot of volume. So the previous example where we saw large traders trapped would be a very short-term, high participation area. But why is there that focus on areas of high participation? Well, partly it's because it's easier to read, and partly because it gives us a more precise entry point. So when a market is in a short-term trend, it will pause and trade volume in an area, then it will move on, pause and trade volume in an area, and so on and so on. And in between the pauses, we actually see there in these middle bits an average or a low amount of participation, usually with an imbalance. And in this case, a move up, we'd expect the buyers to outpace the sellers 1.5 to 3 times. Then we get the short-term balance area. And generally speaking, the trade in those areas is usually fairly balanced. And the trade there is a mixture of things. You've got some buyers taking profits. You've got some sellers initiating new short positions, fading the market. You've got buyers initiating long positions. And you've got, of course, some arbitrage trading. The simple fact is that people are just a little wary of keeping on buying in a one-way move. So anyone that is long is going to have to sell to take profit. So it's only natural that the market kind of balances out, takes a breather after a move. Now, a lot of traders have a problem always fading the market. Every time they see a move up, they want to sell it. And every time they see a move down, they want to buy it. And of course, when they see these high participation areas after a move up, the first thing they think is reversal. And the thing is, though, even though you see this, the path of least resistance is still to the upside. It takes a lot to turn a market around. So the market will generally continue onwards after a high volume, high participation area more often than it will reverse. So what tends to happen is that the bottom of these high value areas will hold, market will push up, and the new shorts that got short in this high volume area, they get stopped out. That helps to initiate the move, and we get move, range, move, range, move, range. At some point, one of these high volume areas here will get washed out. So on the way up, these high volume areas will hold. And the first time you see one of them fail, that is when you start looking more seriously at a reversal trade. Or rather, that's when you can change your bias to short. Well, why is that? Well, on the way up, the high volume areas held as we pushed up away from them. The new shorts that initiated in these areas got stopped out. Longs are winning, shorts are losing. But when we move down from an area of high participation, it is the first time that buyers are getting stopped out. So new shorts here have had market move their way for the first time in a while. So that makes shorts happy and the longs nervous. Those with existing long positions, maybe from down here, from earlier on, they're going to be looking at taking profit or potentially losing those profits. The newest longs above us are also sitting on losing trades. So it may be obvious, but let's go there anyway. There actually aren't long traders and short traders. So sometimes we sit there and what are the longs doing and what are the shorts doing? Yeah. Okay. There are no shorts and longs, right? There's just people trying to exploit moves. So people that are long will switch to selling if that's where they think the money is. And that's what pretty much everybody in this room does, right? You're just trying to make money either way. You don't care whether it's going up or down. You're just trying to make money out of it. Now, if I've got my buyers and sellers the wrong way around, Siraj, there, I do apologise. I do get that confused sometimes, especially sometimes with the mouse as well. Now, none of this is rocket science. It's just a matter of considering other traders' position. So as a reversal trader, you can keep shorting all these high volume areas, or you can wait for one to fail. Now, of course, when one of these areas fails, you have to look out for this scenario on the right. And this is basically when we get a downside push, but it's really just expanding into a much larger high volume area. So basically filling up and joining up these two volume areas here. And when that happens, if you're short, you need to consider whether you want to stay in that trade, because this is quite often the start of hours of the market moving sideways. So range expansion always has to be on your mind. It's a sort of fake reversal, if you like. So always be aware that, when you see this washout, it's great. It most likely means market's reversing, but, now and again, you've got to watch out for this fill in here. So we have moves, short-term balance areas form, and some become much longer balance areas. The shorter-term balance areas usually start with a lot of volume, just trading across one or two prices. So when you're seeing a move up, keep an eye out for unusually high volume at a narrow range of prices, and watch as we cross over these prices from above and below. So you will soon, if you do that, it doesn't take long before you can see, a little bit of high volume at a couple of prices. It moves up, trades high volume at two prices, moves back down through it, moves up through it again. Within a minute or so, you're thinking, yeah, this is going to range here for a while. And within minutes, and that's often less than a single candlestick for somebody watching a chart. So just keep an eye out for that very high volume just trades right here, right now at a single price or two prices. Now, low participation areas can be just as rewarding as high participation areas. Now, by low participation, I mean areas where nobody wants to engage. And I'm also talking about right here, right now. I'm not talking about low participation areas from last year, last week, or even yesterday. I'm talking about areas where suddenly nobody wants to engage. This is order flow, right? Not long-term market analysis. Now, to an extent, looking for a lack of activity is a bit harder than looking for a lot of activity. But think of this as a three-dimensional trader though. A point of low participation means nobody wants to trade at a certain price. The upside of trading there is a low participation area is less prone to manipulation than a high participation area. So, for example, as is quite often, we might have a move back to the high of the day you made an hour ago. That's an area where you have both breakout traders and reversal traders looking to engage. And that means it's an area where predatory traders can nudge the market around to get a response. A high volume node we've been trading for the last 20 minutes is also an area that can be nudged around. We might nudge out through the top of the high volume area to catch the breakout traders. But on the other hand, when a market is pulling back and suddenly nobody's trading, there aren't many traders for a predatory trader to push around, right? So if there's nobody trading there, there's nobody to push around, and there's no benefit in doing so. So you tend to get more stress-free trades that when the move does initiate, it tends to initiate quite cleanly. So it is a little bit harder to spot, but it is actually easier to trade. Now, as well as being a bit harder to spot, trades off low participation areas are a bit less accurate. So you're not looking at a high volume area to lean on. So in the earlier slide, we had buyers trapped at 37. 37 was therefore a clear line in the sand. And if the market moved up through 37, then we know the buyers won out and, they were trapped, but they kind of pushed through. So you simply don't have that kind of price line in the sand with a low participation area because nobody's trapped. And that is fine. It's just a different reason for entering, and it'll have a different reason for exiting. So this is a prime example of where we'd expect low participation. So again, we're in a move up. We've had an area of balance where both short and long traders initiated new positions. As we move up, the new shorts get stopped out. As we move back down, the pullback, we often get as low as the top of that previous high volume area, and suddenly nobody's there. The shorts that just lost money here don't want to lose money again. So think about that. If you lose money shorting 21.50 and the market goes back to 21.50 5 minutes later, is your first instinct to short it? Most likely no. And if it is, you're the exception, not the rule, so you need to understand everybody else. From a three-dimensional trader perspective, it makes sense that there's likely to be a lack of sellers there. And if you pay attention to those areas, I think with experience, you're going to agree with me. Now, as I mentioned earlier, a lot of educators and tools stick to high participation areas, but sometimes what you don't see It's just as important as what's staring you in the face. So we have high participation areas, low participation areas, and in between those we have the moves, the turns in the market, whether pullbacks or full intraday reversals. They can be highlighted by exceptionally high and low participation. But what about in the middle? You know, that area that you're never actually looking to get in a trade, because everybody wants to trade a turn, whether it's a full reversal or a pullback. Very few people want to get in when a move is underway, or rather very few retail traders or educators talk about getting in there. Yet there are obviously a lot of traders trading these moves, or the move wouldn't actually happen. Now, in a recent scalping webinar we did at Jigsaw, we actually looked at strategies you could employ to scalp in the middle of a move like this. There's a lot of prop traders that would be actually adding to their positions here, and there's no rule, there's no law that says you can't actually enter here in the middle. In fact, momentum is the ultimate confirmation that the market is continuing after a pause. You do give up some ticks on entry, but you will be right more often. Timing is obviously a concern because, if you get in too late, you risk getting in just as the momentum dies out again. So these moves are areas where there's a lot of directional trade occurring. You see a lot of size hitting the market during these momentum moves. There's traders throwing hundreds and hundreds of lots per trade at the market, and these people are obviously not idiots. So looking at these areas as bad places to trade actually makes very little sense. Mr. Retail is basically sitting there waiting to put on his one lot reversal trade, watching all the 50 lot fools trade this with momentum. Okay, think about it. Now just bear in mind, next time you're watching the market and next time you're watching a one-way move, and just think about the size hitting the market. Who are these people, right? They're not, nobody trades 50 lots if they're stupid. Now to an extent, we can predict where momentum is likely to commence because it's often on the break of a high volume node. So one side win, one side loses, get stopped out. Market makers also won't stand in the way, and they are more likely to follow the move up, trying to pick off those people who are trading against momentum. That's basically easy money for a market maker. Now, momentum doesn't last forever, but as a three-dimensional trader, you have to embrace it and understand it, because momentum is perhaps the most overlooked aspect of order flow analysis, certainly in the retail world. It's that pure ebb and flow of the market. It's the touchy-feely part of order flow that lots of traders don't want to go near. It's the single most important aspect of using order flow to manage trades. If you can't recognize momentum, you won't know when momentum is against you. You will end up trading against it. And those trades will pretty much immediately be losing trades. Now, momentum is the first thing that we tell new users to Jigsaw to actually look out for. And one of the reasons we look for momentum first is it helps you manage your trades. So as a three-dimensional trader, I hope you don't mind if we look at momentum at the same time we look at trade management. So let's look at a trade. In this example, we'll look at a trade moving against us without momentum and moving our way with momentum. So what have we got? We've got a short position here at 37.50. I think this was last week or the week before. Market just opened. We can see that at the open here, 39, we had a lot of trade. So you might remember this from, like I said, last week or the week before. I've had the flu. Can't quite remember. But this was an unusual open. So 5,000 contracts right at the open price, and it ticked through there, and only 313 buy market orders traded above that before we dropped out. So that is very unusual, and it's significant. Generally speaking, anytime you come back to the open price, the market has the potential to reverse or at least bounce. Not because it's a mythical, magical level or some mathematical formula or whatever. It's just because so many people watch that price. Okay? After all, if there's no people, there's no reaction. So on this day, at this time, that open price is the backstop for a trade. Now, don't take my word for it. Watch your market trade around the open and see it for yourself. The earlier it goes back to the open, the more significant it is. Now, it's a backstop here, partly because, well, it's the open price, and partly because all of these positions up here. If we break through here, if we break through 39, the shorts from there are going to get stopped out or they're going to unwind. So we really don't want to be trying to get out. We don't want a stop loss up here. You know, we really need to actively manage the trade. If we put a stop loss at 39.50, we're going to slip, right? Because there's going to be so many other stops at that price. It's going to be, you know, it's going to get through 39.50 and to 40.50 before you know it. And another way to look at that, right? If you're ever long at this point and you've got a target at 39.50, that has to be the dumbest place to put a target, because if it gets through the high, it's going to start to trigger stops. And if you've got your target at 39.50, you're either not going to get filled because the stops weren't triggered, or it's going to shoot straight to 40.25 or 21.40. So, you know, if you're thinking of putting a stop here, you might as well just put a stop a few ticks higher up, because you're going to have a flood of stops as it goes through, and there's no point just taking advantage of the early part of that stop run. You want to get, you know, 3 or 4 ticks above and take advantage of the latter part of the stop run. Anyway, what we can also see, just another thing, large offers above the high, we can see here and on the heat map. That's normal. I would not say that's indicative of anything much more than people have got their eye on this price. We're not worried about it for now. Because we don't think we can get through that price. We've got our backstop right here. Now, if we look at the strength meter, this reset when we enter the position. So as the current trade. So that happens when we get a fill. That's done basically so we can easily focus on the flow of trade since we got in. Okay. And not surprisingly, given the location we got in, trade moves against us. Now, not surprisingly, because we'd actually started to build volume in this area, and we'd got in short at the bottom of that high volume node. So, you know, we expect it to rotate around this area, you know, and possibly worst case, you know, expand to a much larger high volume area from, you know, 37 to 39. That would be our worst case. Now we can see the strength meter is showing 16,000 sell market orders versus 12,000 buy market orders. So we do have more sellers than buyers, which is good. What's bad is the sellers didn't get anywhere yet. So the sellers are offside. You know, so while the market doesn't have any momentum to the upside, we could not stay in this trade forever, as at some point the shorts will bail. Now in terms of large size, we could see it's about even, perhaps a few more large buyers than large sellers, but really more because we've moved to the top of the range than anything else. But overall, price has moved against us, but the order flow hasn't. There's no imbalance against us. There is no momentum against us. So as a three-dimensional trader, you're going to put your feet in the shoes of the other traders with positions here. So if you think about how you feel when you're in a trade and it's not going your way, you know that the longer that continues, the more nervous it makes you feel. So while this market certainly could range here for hours or even eventually go our way, there is also a probability that it will break against us. And sitting through trades like this, day in, day out, you will know that time is not your friend. The more time that passes, the more nervous the other traders with the same position as you will be in, and the more likely it's going to break upside if it stays above 38. Obviously, if it comes back down in the middle of this range, it's not a problem. So there's no momentum either way, but you basically don't want to wait forever. In other words, you're not in trouble yet, but the longer this lasts, the more your risk increases. And now we have momentum. Now, momentum is something that can't fully be captured in a screenshot. It's excitement, it's speed, it's change of pace. It's a whole bunch of people all moving in the same direction. It's something you would never want to trade against. And that's why at Jigsaw, we get people to look at this first. So getting a feel for how the market ticks up and ticks down, speeds up and speeds down, or slows down, gets stuck. So both high and low participation areas are much easier to read if you already know what momentum looks like. Now, what a screenshot does show is a couple of things. Balance of trade, as we expect, is about 1.5 times sellers to buyers. The imbalance from before has grown. we can see on the current trade columns here, these big numbers as it chews vertically down through the bids. At the same time, we see overall less buy activity, less buy market orders hitting the offers. On top of this, we can see the bidders here pulling out of the way and the offers adding contracts here. Now, a picture is being built here that's quite easy to read. However, if you go back to a one-dimensional trader view and ask, you could ask, well, what's the pattern? What's the exact number of contracts pulled on the snapshot I need to tell me there's momentum? And if you did that, you'd be completely missing the point, right? You'd be back to looking for that single magic data point to make life easier for yourself. And also, you'd be making it much harder to read. Because the reality is, you are not reading the individual numbers at all. You're watching the flow and absorbing the overall picture. You can look at that, and without remembering all the numbers, you can see they're pulling the bids and they're adding the offers. You don't really need to know the individual numbers. Okay? So you don't need, and again for the selling, you can see many more sellers and buyers here. You don't need to read the individual numbers. Like literally a glance is all it takes. And these momentum moves don't last forever. They are smaller moves on thick markets like the E-mini S&P 500 and US Treasuries, and they're much bigger moves on markets like crude. Now, if you can read and absorb the order flow information, then within weeks, you should be able to use order flow information to help you manage your trades. That trade management, deciding whether to stay in a trade or not, involves the simplest order flow reading skill, this reading momentum. So reading momentum in itself is fairly simple, but in my experience, it's something you just need to set aside time to learn it. And that means actually sitting yourself down and saying to yourself, right, I'm just going to focus on reading momentum this session. Give myself an hour, right? And just repeat that a few times. And when you move to a different market, say, man, I've had enough of this crap range on the S&P, I'm going to move to crude. Sit down with crude and just say, right, I'm going to sit down a few days, do an hour a day, sit down with crude. What does momentum look like on crude? Okay. Now, a lot of, people come to order flow just looking to see when a market is turning. So they just focus so narrowly on looking for icebergs or absorption to occur that they aren't really noticing or learning how the market moves between those reversal points. It's just washing over them. But think about it. To see a market slow down, you really need to understand it at regular pace first, or you won't know what slow looks like. So momentum is about pace, it's about size, it's about market makers getting out of the way. It's an extremely rapid one-way move is a sort of a momentum, but it's quite often accompanied by very low volume traded at each level. And for various reasons, that doesn't make it a strong move. So what you really need to see is kind of moderate pace with decent volume trading at each level as it progresses. And if you remember what we talked about, liquidity vacuums, if the market goes too fast, it's just going to pull back and get sucked back into that vacuum. So you want to see fast but not too fast. And the only one, but Pete, what's fast and not too fast? Can you tell me how many ticks down per second is too fast? If you just watch it, you'll see it. If you just watch it, you'll see it. Okay? You just have to accept that I've just got to get used to watching this a few times. Now, quite often you will enter a trade and the market just wiggles about. Okay? There's no momentum against you or on your side. So price might go above and below your entry point, but there's no conviction. Then you'll see 800 contracts tick down, 700 tick down, 600 tick down. Then you'll know momentum is starting and that there's real flow coming into the market, that this isn't just the wiggle anymore. So you now have information that behavior is changing, and you can use that to help decide when to kill or keep your trades. Now, this is a slide we looked at in session 1. And I'm hoping that at this point, I just want to break out and look at this at this point, because I'm hoping that this actually makes more sense now. The message, if you recall, is that those trading as frequently or less frequently than you are the people that will have the most impact on your trading. So if you're looking for 20 ticks on a trade that you're going to hold for an hour, you don't have to worry about people getting into and out of the market in a couple of 100 milliseconds. They're simply not going to have that much impact in the market on your time frame, other than slowing it down a little bit, because HFTs are mostly making markets. On the other hand, as we've seen, clusters of positions in an area will cause a short-term move. So if you're going to hold a trade for 2 weeks as a swing trader, you wouldn't care about those short-term moves. You wouldn't care about those clusters of volume. They're just not significant to you. But as a day trader, it's important to know if the amount of participation is changing. So some days you'll have news before the open, followed by a higher than average participation and a directional day. Sometimes you'll just open in the middle of the range and you'll chop around with nothing really happening. So you have to stay alert to these changes as a trader, because if you understand we have lower or higher participation than normal, you can expect volatility to change accordingly. And part of the process is keeping track of the amount of volume traded. Now in this image, we can see an indicator that compares the current volume to the average volume for the time of day. And if that is moving up, we are currently seeing higher than average volume. If it flattens out, volume has reverted to average. So we might start the day with above average volume, but at any time we could revert back to average or even less. In this case, we're outpacing the average throughout the day from the open, and we ended up 500,000 contracts above average. The higher the participation, the more likely the people in the time frame above you are active in the market. And that volume is just one part of the picture. The other part of the picture is the market depth. So this is the S&P 500 again, and as we can see, the average depth is 700 or 800 contracts. Now before a scheduled news release, that could easily drop to 100 contracts average or lower. Now we all know that not all depth is real, but when the depth increases or decreases, it does impact volatility. Now the first thing the one-dimensional trader is going to ask is, well, how much volatility is a lot on the S&P 500 and how much is a little? Now I understand you need to get experience, okay? But I'm going to, people say, I understand I need experience, but can you just tell me the numbers? Then they might set up alerts looking for those specific numbers, and in my opinion, it's just an attempt to dumb down the information. Now, the amount of liquidity on the S&P 500 is to an extent a reflection of HFT participation. And when the VIX spikes, market makers tend to ease back a little bit, and the bids and offers are much lower. Now, the amount of participation can change intraday, but usually a thick, slow day is going to be like that right from the start, okay? You'll see high bids from the open, you'll see a lot of contracts trading per level 2, and all you really need to do to kind of get this situational awareness of, whether volatility is changing is just look at the depth for every 5 or 10 minutes. Just look at these numbers, quick eyeball. Even if you're not using order flow in any other way, shape or form, you could do that. So right now I could tell you that if I saw 1200 to 1500 on average per level, I'd expect the market to be choppy. If I saw 400 to 500 per level, I'd expect volatility. If I saw 200 or less per level, I would expect we're about to hear some news, or maybe I've missed the news, or some news had just hit the wires. If I saw 2000 per level, I'd probably fall off my chair in shock. That's right now though, October 2016. It could well be that in a year's time, 2000 is the average. And the S&P 500 now is much thinner than it was 3 or 4 years ago, but at this point in time, just by eyeballing the dome occasion, look at the depth, I can get a feel for how volatile the day will be, or might be, and adjust accordingly. Now of course, this isn't just about comparing one day to another, it's also being on the lookout for when a market is switching from range bound to trending and vice versa within the day, because markets absolutely switch gears intraday, and charts are only going to tell you that after the event. So the volume, the depth, and changes in volume at price is giving you that information in a much more timely manner. Okay, we've got a few more slides to go through. Staying with our behavioural theme, let's look at something that occurs frequently in the market, a head fake, or also known as a fake breakout. And this is very important if you're looking at high participation areas and their failure, because there is a big gotcha when a range breaks. And that gotcha is that sometimes the break fails. Now this is the only case where I would personally go for the hero trade or buy the low of the day trade, that kind of full intraday reversal trade. Now we'll take a look at crude this time. But for those on thicker markets than crude, you're going to look for the same thing but over a range of fewer prices. So head fakes generally occur in two places. One is your typical double top or double bottom, where we poke through the old high-low. On the ES, it's typical to poke through 2 ticks in reverse. The other, as in this case, is after the market's been in a range, okay? Which could be a range that's been for minutes, or could be a range that's been for hours. Now, to me, the most reliable head fakes are the ones where the market's been in a range. As the market moves sideways, we are building positions in that area, and we can see here the low 50s. We can see it's now become a high participation area. In this case, maybe from 50.09 to 50.15 is where the bulk of the trading is. Now, with more volume traded here, we have more positions here. We also have traders starting to get a little bit bored. Crude traders probably get bored more quickly than those trading index futures or treasuries, because crude traders are used to a lot more excitement. So as we move away from the range in the direction of the prevailing trend, we can see, the buyers from above, looks like some buyers have got stopped out. We can see a flood of sell orders down to 96. Some of those are probably stops. At this point, there'd be a general sense or a feeling that the range is broken, and people are going to jump on that break, okay? Now, like I say, if you're looking for this in crude, you're not looking for such a big push down. Sorry, you're looking for this in the S&P 500, you're not looking for such a big push down. So it appears that the continuation move is underway, and for sure, you're going to have people feeling like they've missed out. As I say, we see on the way down, we can see we had size hitting 50, 49.99, 49.98, all the way down really to 49.96. On the Vista chart, we can see 3 large circles, with the lower circle being the largest and mostly sell orders. So we had that excitement on the way down, and then the market got very thick and absorbed a lot of the selling, especially at 49.98. So we have an area where new sellers are potentially trapped after the break of a high volume area. And this is how it played out. We can see that from the moment the bidders absorbed the selling, we saw down here, the bidders absorbed the selling, we saw a lot of buy side liquidity coming beneath the market. And that's a definite heads up. It's not a guarantee, but basically when you start to see a lot of orders come in after when the market pushes away, it's a good sign that maybe some market makers or some liquidity providers would like to buy that price. Now with a head fake, you get that kind of euphoria after the break, creating the opportunity for passive buyers to absorb the selling. So I say passive because this guy, the bidders here that absorb the selling, they're just waiting for traders to come to them. So when you see that, it is an area right at this point here that you could join that passive buyer. That's your kind of early entry, your aggressive trade. The less aggressive trade is when the passive buying turns into aggressive buying, where you see buy market orders start to hit the market and for the market to lift up away from where the passive buying occurred. Okay, so this here, this absorption, we had sellers selling, the bidders stood up and absorbed it, then the bidders turned active. Then we saw buyers come into the market. That, to me, is the safer trade. That's why you don't see a trade at 49.98. Yeah, I want to see these guys down here get stopped out. Look at another example of this. Certainly a better example. It's a good example for a different reason. And this is on wheat. Now, in this case, there's no real sideways action. We had a push down to 1675 here, and then the market moved up. And then we got a push through the low. So this is kind of, it's not quite a double bottom, but it's almost your double bottom head fake. It's kind of, I say it's not a double bottom because it wasn't very long. It didn't really trade a lot, when we came off this low here. But it did what a double bottom head fake will usually do, which is push down through that low, and then we see a lot of absorption and then push back up. So again, we got the push through the low, and once more, we saw that passive buying. Now, also note the circles, the imbalance. We got 3 circles, mostly selling. In other words, as that selling was going on, there weren't many active buyers at all. It was the passive buying that was the trigger for the move. Now, there are traders out there that trade size that is really sometimes hard to conceive or hard to imagine. Okay, so there could quite possibly, for example, a trader out there that was looking to, his job for that day was to get positioned 3,000 contracts on wheat. Okay, he's not going to be able to do that all at one price. But what he could do, he could start, let the market come down and start by building that position passively. So by that I mean he can put in the bids and let people come to him. But the thing is, if he's got to fill 3,000 contracts, he can't just put a big bid down here and wait for 3,000 sellers, because 3,000 guys, he's not going to get 3,000 contracts sold to him, right? It's never going to happen. So it's rare to see the stuck sellers just carry on, sell, when it's not able to move through. It does happen now and again, okay, but it's not the norm, okay? And it's not the norm when you're expecting a head fake. So eventually, this guy wants to buy 3,000, and he's put his limit orders in there, but the selling's going to dry up. And then he's going to move from being a passive buyer to an active buyer by entering buy market orders. So when you see these circles here, please bear that process in mind. Anywhere you see absorption like this, it does indicate passive buying, but when that passive buying turns into active buying, it is a very different situation. Okay. Now in this case, we can see that the 201 contracts traded at the bottom is a real outlier. I mean, if you look at what traded everywhere else, 201 is way bigger than we saw trade anywhere else on the way down. Now, as we move up from there, we can see an imbalance as we move up. You can see an imbalance on the current trades to the buy side. We can see the same thing on the reconstructed tape. The switch from passive to active buying is actually quite clear here. So you don't necessarily have to shy away from trading this stuff just because you've moved up 3 or 4 ticks and you can no longer buy the low. Think about those mid-momentum moves. Okay, let the market move up a bit. It doesn't mean it's a poorer trade. Okay, next slide. As you can see, we continue to push up, and where we are now, we've actually hit the first high volume area above us. Okay, so if we wanted to take a long, this price here, 420, would really be the first hurdle in the way of a long trade. So when you're considering where is, too late between, this absorption down here and the move up, where is too late? Well, I'd say for me, this would be it, this 420. Okay, so this would be a natural first target for me, and I'd not want to be initiating a new long here. Now, that's not to mean it won't continue up. It's just that, we've potentially got some happy short, we still got some potentially people who are short from this area. And we're moving up to that place where we've potentially still got some of those happy shorts. So, we've also got some people who lost long trades in this area. And that could combine when we get back there to give us a downward bias. It's not something I'd trade short. It's just something I'd be like, yeah, well, maybe all the shorts, maybe all the shorts are gone now and maybe the longs will be okay now. But I'm not really comfortable taking a short there, because of how much we pushed down. We could end up holding. Like I say, it doesn't mean it won't carry it up. It just means I'd like a little breathing room in a trade before I get to that price. So I'd have time to get out if I felt like the sellers were being aggressive there again. Excuse my voice, I don't actually have the flu right now, but it's held out quite well. Anyway, just get to the end of the presentation. So when you adopt order flow, you will most likely feel a big industry push towards focusing on areas of high participation. In my opinion, that's not the best place to start. So in terms of getting results earliest, here's how I'd approach it if I had to start again. First thing I do with order flow is overall participation analysis. In other words, having an idea if today's volume is above, below, or around average. Now we all know that if the volume grows up, then so does the volatility. In addition, glancing across at the market depth every few minutes will tell us if the market is thickening up or not. Now, using this information is, in my opinion, the lowest risk change you can make to your trading, yet there is still decent upside, especially when a market moves from trend back to chop and vice versa. After that, I'd study momentum with a view to using it just to manage trades. And again, this, in my opinion, is also a fairly low risk change to your trading. If you can use momentum to manage trades, it's not that big a change to your overall technique. And it's certainly not as big a change as using momentum to actually change your entries. Okay? But once you can use momentum to manage your trades, then of course, maybe the next step, use momentum so to not enter trades. So if I've got clear momentum against me, I am not going to enter that market. It's kind of a no-brainer, really. I've actually sat in trade rooms where they're not using order flow, and I've been watching the order flow, and I'm like, no, and boom, the guy gets run over. Next thing, I would look at high participation areas and how they develop and how the market moves around them and what happens when they fail. So anytime an exceptional amount trades, it can be significant and it can provide you with a backstop for your trade. So just bear in mind that a lot of other traders have their eye on these levels too, but it is the easier thing to learn to watch. Then I'd look at the more nuanced, low participation areas, places where no one is looking to enter and the market just dies out. So that's personally my favorite way to get into a trade, but it does take a little practice. I like it simply because there's nobody else there trying to nudge me out of my position. And the simple fact is, you're going to have to do that anyway, because you can't rely on there being high participation or absorption occurring at every decent place to enter the market, right? It's great to see the big circles, but at the end of the day, sometimes the market's just going to run out of steam. Now, the key thing to remember about the market is that your goal, to make money and not lose it, is also what the majority of other traders are doing too. Now, it is true that some traders are not concerned about the profit on their individual trades. An arbitrage trader only cares that his combined trades make a profit. A trader trading, guy working for an airline trading crude contracts might simply be trying to guarantee against future increases in fuel prices. The profit on that trade is absolutely irrelevant to him. So hedging and arbitrage, whilst significant, can't explain the sort of intraday moves we see in the market today. So we have a 1.5 million contracts traded on the S&P 500. It'll move up 10 points, down to 12 points, and close just a few ticks from where it started. And the only real explanation for that sort of price movement and going back to where we started is that it's a whole lot of people getting into and getting out of the market within the day, or just short-term speculation. So if you're looking at the market as a thing and yourself as a person, in other words, you're not what the market is, you're probably missing the point. The market is nothing more than people or machines acting on the behalf of people trying to make money out of each other. And when you look at it like that, it makes a lot more sense. It makes it easy for you to put yourself in the heads of other traders that might be stuck and those that are making money. It becomes a little easier to preempt other people's actions and to know also when your analysis is wrong because you just called it wrong. Now, if speculation is driving the markets most of the time, then most of the time it's short-term speculation, but changes in participation should tell you when it's not. So a big increase in participation, especially after a news event, is a heads up that the personality of the market is going to change. Now, the three-dimensional trader won't be scared of looking at the market in terms of other traders, speculation, pain points, because that's really what the market is. It is not lines on the chart. So when you dumb down the market into simple patterns, you lose clarity. Okay, you think it's more clear because it's simple, but it's less clear because you don't have enough information. Now, you shouldn't just grudgingly accept this. You should really embrace this with both arms. So give it a hug and a few kisses, in fact. It's better to embrace this sooner than spend 10 years looking for simple patterns to trade. Now, saying that, I speak to a lot of traders, and most of the really successful traders say that the most important part and the real skill is getting out of a trade when you're wrong. Being able to book a loss or scrap a trade at break even when it's not going well is actually one of the most important elements in the way they trade. So don't forget that aspect of trading, the exit part. It's just as important as the fun part, which is getting in. Anyway, now's a good time for you to type questions. We've got a few up there anyway already that I'll go through. I hope this webinar gets some of you thinking a little bit more deeply about the activity you see in the markets rather than just lines on the chart or numbers on the dome. So we try to focus here on the why more than the how, because I get a lot of people asking me how, but I very rarely get people asking me why. But if you understand why the markets are doing certain things, then without doubt, you will discover your own ways to take advantage of those moves. So new traders tend to be absolutely in awe of anyone that can discover their own trade setups. But that's just because they're so focused on the how to trade and they don't really care about the why. Anyway, hopefully this train of thought is something you can carry into your own trading. And as you see shiny new trading techniques, you'll get those emails, you'll ask yourself why before you bother finding out how. Anyway, let me just go through the questions. Right, first question has left. Oh, don't worry about him. Okay, if moving up market has less resistance, continuing the upward direction, how does this fit with your description of market prices breaking through floors and ceilings, saying that the path of least resistance is back through where price formed? Okay, that's the liquidity vacuum. So a liquidity vacuum is a momentary collapse in price. So you could see that as like ultra short term directional bias. But overall, the market will carry on. So it's just basically the liquidity vacuum is the market taking a breather or just a momentary collapse. But when you've got high volume nodes, overall momentum, overall market direction is still with the prevailing trend. Do you have info on how to identify between beginning of a momentum move out of a short-term balance area and a break out of balance where traders are pushing prices to trigger stops? Well, it's very difficult to tell whether a range is breaking for momentum or whether it's just somebody nudging it out. And I think basically the only way you know is by watching for the head fake. So basically, as it breaks out, you look for an area where a lot of volume trades. So if you trade a breakout or a pre-breakout trade, you've got to watch, you've got to look ahead. And the moment it stops and a bunch of volume churns, if that's like 5 or 6 ticks away from the range on the S&P 500, or it's like 10, 12 ticks away, on crude, it's a head fake. You get out, basically. So it's actually the stuff we talked about, head fakes, that helps you to see that. Yeah, Tony, you said, where should the entry be? When you turn from passive to aggressive, it's gone a few ticks. Absolutely. It's, what we try to look at today is actually talking about how the market moves, not so much how you capitalize on it. So if you see the passive buying, you can buy and join those guys. If your market is really slow for that day, and you've got a day on the ES where it's a 5-tick range, that's where you're going to have to enter. If you've got a more normal day, you can let the market move away from the area and then enter. But you basically, what you're doing, you're paying for confirmation in ticks, and it's really down to you with an understanding of how the market works to kind of decide how you're going to play it. When is too late. But again, if you look ahead on the wheat example, we had a clear rundown. I don't know, about 12 ticks of very little volume traded. So when you get into an area where we didn't trade much volume, you're generally going to get to the area, the next area where you traded a lot of volume. So I'd say, it's up to you whether you get in early with the absorption or wait for the momentum to start. And then I would say, look at where the next high volume area is and say, well, that's your target. And, based on, when you're deciding, is it too late, you've got to base it on that target. Seems counterintuitive for low volume areas to be less manipulated. Wouldn't a large trader have an easier time whipsawing trades at key levels prices? Well, John, when we're talking about low participation areas, we might go down to a price and, we're trading 500 and tick down, 500 and tick down, that kind of thing. Then we might trade 40 contracts at a price and then 10 contracts at the net price. And literally nobody wants to trade there. But that amount of contracts, that amount of trade isn't worth nudging the market around. With no big volume and no line in the sand, it's difficult for the manipulators to even know whether they push people out. So it's just, what I'd say is watch it, and watch it and look for yourself. My impression is there's less people, less manipulation. Some 2020 vision is just basically it's a webinar topic we did. It just means perfect vision, basically, not the 20/80 rule, but I think that the Pareto's rule does apply in trading. If you look at all these, we've gone through a webinar that's been quite simple today. Just covered a few concepts, but very powerful concepts, and you could become, you could have encyclopedic knowledge of order flow if you want. But to be honest, if you use the main points in your trading, you're probably good enough. You probably don't need to have that encyclopedic knowledge. Correlated markets. With correlated markets, Tom, I use the NASDAQ and the Dow, generally speaking. And I also use the NYSE tick, or my own take on the NYSE tick. I'm just looking for something very simple, basically. I'm trading the S&P. I'm looking at two more volatile markets. If I'm about to go long, but the NASDAQ and the Dow are tanking, I get out. If I'm at an area where I expect a break, and the Dow and the NASDAQ break, then I might get in, because the Dow and the NASDAQ are showing me that they'll probably take the S&P with it. So it's a very simple, very, very simple concept of just saying, as long as the other stuff's against me, I'm going to stay in and I'm going to get into the trade I want. But if the other markets are really tanking, then I'm not going to go long on the ES. The exception to that is when the Dow and the NASDAQ are doing different things. So when the Dow does one thing and the NASDAQ does something different, generally speaking, the S&P 500 is going to be choppy. And I also do pay attention to that, and I won't expect much from a trade if the Dow and the NASDAQ aren't doing the same thing. And that can happen. You can start off the Dow and the NASDAQ doing different things, and they can sync up later in the day. But while they're not synced, it's really, really very short-term trades. Looking at the number of contracts bought and sold as now, showing the Jigsaw Dome. When there are sudden large changes, are these a good direct indication of change of direction? Yes, basically. When there are sudden large changes, yes, absolutely. When you see large change in participation, to me it's not a good. It depends where it happens. So if you see a high volume node after a move up, and then you get a lot of size, hitting on the sell side, then obviously that's a good indication, change of direction. But again, I said at the start, I don't join large size. I will only trade large size when it's trapped. That's all I use large size for. Now I think we are done with the questions. I think so. So thank you all, guys. I don't know how my voice was. I'm feeling a bit nasal here. Thank you all for coming. It is appreciated as always. What I will do is I will put a recording on the YouTube tomorrow and send out a recording to you all. And thanks a lot. And I'll hopefully see you in here again soon.